From time to time, we get news like this that remind us that retail investors can, in fact, beat Wall Street. Hedge funds hit with steepest margin calls since COVID-19. In simple terms, a margin call happens when you borrow money to invest, and the value of your investments drops so much that the broker comes in and demands that you either add more money to your account or sell some of your holdings to cover the loan. And if you don't do that, the broker will step in and sell your holdings on your behalf. Okay, so the article says Wall Street's S&P 500 share index was set to post its worst week since 2020. According to two people familiar with the matter, Wall Street prime brokerage teams, which lend money to hedge funds, came into the office early on Friday and held all hands on deck meetings to prepare for the large amount of margin calls to clients. The report said that the magnitude of hedge fund selling across equities on Thursday was in line with the largest seen on record, as they dumped equity positions at a level in line with the US regional bank crisis in 2023 and the COVID-19 sell-off in 2020. So essentially, they were forced to sell as stocks crashed. And that's why I personally never mess with margin, because we can get hit with these events out of nowhere, which causes investors to overreact and sell out of stocks at rapid rates, and that can lead to some really big losses. And if you're investing for the long term, one of the most important things is to avoid really big losses. Now, retail investors, or the so-called dumb money, can get hit with margin calls, but clearly so can hedge funds, or the so-called smart money. But are hedge funds actually smart money? This data suggests no. Here's a chart of the average hedge fund returns versus the S&P 500 returns from 2011 to 2020. The S&P 500 outperformed hedge funds every single year. So your grandma that knows nothing about stocks and just holds an S&P 500 ETF in a retirement account performs better than the so-called smart money.